The next effect of taxes that we're going to take a look at is their ability to shift you from purchasing assets out of retained earnings, your savings, with cash, whatever you want to call it, over into actually borrowing money in order to finance the purchase of assets. So what we're going to be doing is using the same $10,000 car that we used in an example before, and using that $10,000 car as the purchasing the vehicle with cash. And we're going to go ahead and create an analysis of the purchase of the vehicle with a loan. And essentially what we're going to do is evaluate this with the present worth criteria. We're going to pick the one with the present worth which is closest to positive infinity. So in this example, what we're going to have here is this $10,000 car. That's the cost basis, which is exactly what we had before. The other thing that I'm doing is I'm giving you a loan rate. We're going to create a very special kind of loan so that we don't have to do every single month. What we're going to do is we're going to make it so you only have to make one loan payment a year, and your first payment is going to be in the year after you purchase the vehicle. So what I've done here in order to figure out what the payment is I've just used a spreadsheet function, which is payment, in order to find out what the payment's supposed to be. But you guys know that what you're supposed to do is find what the A is, given you know P. And so the P in this case is $10,000, and then you looking for A, given that you know P. The interest rate is just the interest rate per payment period. In this case, that's an annual rate. The payments are annual, so it's 7%. And you're going to be making just, 5 payments on this particular car. And so we're just going to spread out the loan over the period in which you depreciate the asset. So those are what your annual payments are, $2,438.91. And what I've created over here is an amortization table. And so here are the years. Notice that in the first year you don't make any payments. And here are those identical payments every single year that you make. And what I've done is expanded it out so that you can actually see what is an interest expense, what is the principal payment, and what is the balance remaining. And we need to split these guys up because although this is the payment that you make, this interest expense is the only part that is an expense that shows up on your income statement. And so what I've done is said, well, look, you have originally borrowed $10,000. There's what the payment is. And if you recall how you calculate the interest expense is you multiply your balance remaining, which is $10,000, times that loan rate per payment period, and that gives you the interest expense that is contained within the full payment. In this case, out of the payment of $2,438.91, $700 of that is interest, which is going to be later on used to reduce your taxable income. The balance, and I mean that literally all I'm doing is taking the payment less the interest expense, is going to be the principal payment, and that goes towards withering away how much you borrowed. So what you do then in order to find out what the balance remaining after the first payment is you just take your balance remaining, you subtract off the principal payment, and that's how much you owe after you've made your first payment. And you do similar things with each payment thereafter. If you look at the interest expense here in your second payment, all that you're doing is taking the balance remaining after you made your first payment and multiplying it by the interest rate right here, and that gives you the interest expense in that second payment. And so again, principal payment is just the difference between the interest expense and the payment. And then what you're doing is just subtracting that principal payment from the previous year's balance remaining to get the new balance remaining. And since this is a fully amortizing loan, the balance remaining goes to 0 as you make your last payment. So this right here is your full amortization table, and we're only going to be using this interest expense as well as this payment series. So let's zoom on up really fast to go ahead and take a look at our analysis of what happens because of taxes here. And I've laid out the years just as we had in the previous example. And instead of having a $10,000 purchase right here, what we're going to see is negative cash flow of all these payments that you're making. So these are exactly these same payments down here. So if you were looking at this on a personal finance basis, you can see these negative cash flows here. And you can also calculate what the present worth of that is at the minimum acceptable rate of return of 5%, something we've done before. So just remember that on a personal finance basis, if you paid cash for it, this thing had a present worth of $10,000. If you go ahead and finance it with this kind of loan, it has a present worth of negative $10,559. From a personal finance point of view, you'd rather pay cash for this vehicle rather than take out a loan. You're going to see that's different in a business context. Now, this stream of depreciation is exactly the same as in our example when we purchase cash. Just because you're financing the car doesn't mean that depreciation changes. It remains exactly the same. This is still going to be an additional expense, which is going to reduce your taxable income, which is going to reduce your taxes. There is, however, this additional expense because you took out a loan, and that's the interest expense. So we have is just that interest expense column from the amortization table. And so you know that in the first time you make a payment, it costs you $700 in interest, and so on down the line. So because we now have these two sources of expenses because you purchased this vehicle, the additional interest expense being there because you financed the purchase of the asset, you're going to have some somewhat larger tax savings than you did when it was just a cash purchase. So what I have here, and I'll just show you the formula, is I'm adding in those two expenses. That's that C3 plus D3. And I'm multiplying it by that combined tax rate that we had calculated before. And this is going to be the reduction in taxes that are there because of those expenses. Those expenses reduced your taxable income, therefore reduced your taxes. And you can check out the after-tax cash flows because you've gone ahead and collected those tax savings. And so all I'm doing here in this case is saying, well, here's what your pre-tax cash flow is, adding to it the tax savings. That's that column E, producing your after-tax cash flow when you finance the purchase of this vehicle. Now, note that the first year you have a positive cash flow, and after that there are negative cash flows. Now, you can contrast with what you had on the asset purchase, right back over here. We have negative cash flows in the year of purchase and then positive cash flows. But please note that the numbers here are smoothed out a bit. I have gone ahead and used that minimum acceptable rate of return to find the present worth of these cash flows. And I find that the present worth of these cash flows is negative $6,102. Now, you can compare that with what we calculated for the present worth of these cash flows when you purchase it with cash. That's $6,326. I've just transferred this number over there. And what you see is that the present worth of purchasing this asset with a loan rather than cash is closer to positive infinity. So from a business point of view, you would rather take out a loan in order to finance the purchase of this vehicle than pay for it in cash. It simply makes better financial sense. Now, it seems contradictory, but it has to do with that interest expense reducing your taxable income, and that's something else that doesn't really happen in a personal finance context. Now, if you want a rough guide on when that interest expense is going to, that interest rate is going to be beneficial to you, there's this idea of a pre-tax and post-tax tax rate. Let me give you a quick example, because you notice the loan rate was only 7%, and you still, which is larger than the minimum acceptable rate of return, which is 5%, and you still kind of went for it. Well, you can alter this thing around to like 9%. Everything recalculates, and it's not quite right. And you can alter this to 8%. There you go. And at 8%, you still want to go ahead and take the loan. But the idea is that these two interest rates, that 8% loan rate and that 5% minimum acceptable rate of return rate, aren't exactly comparable. The 5% rate is an after-tax rate. The 8% rate is a pre-tax rate. And so you can kind of approximately take your loan rate, your pre-tax rate, and turn it into an after-tax rate by just going ahead and taking that loan rate and multiplying it by 1 less your combined tax rate. And that roughly converts it into an after-tax rate, enough so you can make a comparison and say, well, look, the after-tax rate on this loan, this 8% loan, is 4.79%. That's less than 5. It's probably a good idea. This approximation is approximate and only works when you're dealing with some longer payment series. Otherwise, it falls short. Anyway, so the main point to get across is that in a business context, it often makes sense in order to finance the purchase of a vehicle in situations where in a personal finance context you wouldn't think about doing it.